Hi, this is Dr. Elaine Gregory, and this is ACC 4620 Auditing and Assurance 2. Now we're moving into the next three modules where we are going to be looking at specific audit, substantive testing, and analytical procedures on certain significant accounts. So in this first one, in Chapter 9, we're going to be looking at revenue and accounts receivable because they're both tied together. But in Part 1, we're going to focus just on the revenue cycle. Let's take a look at the revenue cycle on the right side. We receive a customer order. We ensure we have the goods, and then we ship the goods. Once we ship the goods, we follow it up with the invoice for the payment of goods. We collect the payment, and we recognize the effect of that transaction within both the balance sheet and the income statement in the financial statements. So in any of these stages, we could have some risk of material misstatement. But I want to focus a little bit on recognizing the effect of the financial statement. We focus in on revenue because revenue happens to touch a lot of accounts. Just look at the amount of accounts sales touches. We could have sales revenue. We have accounts receivable. We would have allowance for doubtful accounts. We have inventory. We have cost of goods sold. We may have sales and discounts and sales returns and allowances. We may have bad debt expense and cash. So we're looking at a lot of different players or actors in these accounts that affect sales. And let's not forget, there could be other ones. We could have warranties that are affected. We could have sales commission expenses that could affect payroll. So the revenue cycle is a very, very large cycle. We're going to look at sales and revenue, allowance for doubtful accounts, and some returns areas. So we're going to focus in just on sales revenue, accounts receivable, and the allowance for doubtful accounts in Chapter 9. But be sure that you look at these others on how they can also be affected. Now, when we're looking at the company, we also want to know what those inherent risks are, those things that may naturally take place as a result of having that account. So first we have to understand, well, what is the business selling? How many lines of products do they sell? Do they sell just a couple of lines, or do they sell a very large group of business products or services? But we're going to focus in on products for this course. And then how is revenue recognized? We know that we have revenue from contracts with customers, which is topic 606. We also have different standards for leases, but we're not going to get into leases right now. So we want to focus in on the new revenue recognition standard. It started back in 2014. It became implemented with revenues from contracts with customers in 2018. And we're now starting to see 4 years later the fruition of the effect of revenue with the changes in the revenue standards. But you have to understand the revenue standards in order to determine if you have risks anywhere within the process. For example, it's a 5-step process to achieve revenue in our system. First, we have to identify the contract with the customer. Is it an individual contract? Is it a contract that encompasses any sales with that customer? Are there contracts set up for the different types of products or goods that are being sold by the client? Then within that contract, you have to identify what are the obligations that we have in that contract. What are we going to do to get money? And part of that is the determination of the contract price. Have we settled on a contract price? And is that contract price clearly identified in the contract? We don't want any type of side agreements going on or things omitted from the contract. But also we have to allocate that transaction price, that agreed upon price, as to the performance obligation. Is revenue recognized at the end of the performance, at the point that the good is transferred to the customer, or is it identified in periods of time based on obligations of performance? And finally, we only recognize the revenue when or as the reporting organization satisfies the performance obligation, either in pieces or at the end of a contract. Now, in the past, we used to do percentage of completion contracts. And percentage of completion contracts never really took into consideration whether or not the organization satisfied a performance obligation. It was just, we have a contract for 1 year, so we're just going to recognize that revenue over 12 months or twice a year or 4 times a year. But there wasn't the alignment between the satisfaction of the performance obligation. So that's become the tricky part now. So if you haven't become familiar with topic 606, I suggest you start diving into it. Now, let's take a look at some of those inherent risks going on with revenue. What impact is there on unusual terms? Do we have some funky terms out there that we may not quite understand? And when does title pass to the customer? Is that a performance obligation when title ownership passes to the customer? Are there any rights of return built into that contract? And if so, does that reverse revenue recognized? Do we have combination of leases and sales in contracts? One of the trickier areas that we've looked at is communication. Cell phones. You have sales of the cell phone itself, or you have a lease of the cell phone. You have a lease of the data part of the contract. So you may have contracts with combinations that you'll have to bifurcate out and need to be clearly noted which part and what it is and where revenue is recognized. And finally, we want to take a look at, are there treatments of sales transactions with recourse? Now let's go over that 5-step process again really quickly. Review the contract with the customer. It must be an established contract. This is new for some companies that didn't have established contracts, so they have to go back and probably rewrite contracts with their customers. What is the risk? The risk is recognizing a contract in the system, perhaps in the sales, where it doesn't exist or is deficient. There has to be an established contract. What are the performance obligations? There's a risk that there's unclear performance obligations, so that the customer may see that revenue is recognized one way, whereas the contract seller may recognize revenue in another way. Are there implied promises? Are multiple goods and services bundled together as one obligation when it should be split out? Are there warranties in existence? When we think about the transaction price, we think, well, that's pretty obvious. Well, the price may be inaccurate. It could be wrong revenue recognition method applied. It may state that there has to be performance obligations and the revenue recognition is not being applied in the same manner to achieve the transaction price. there may be some questionable assumptions in the contract regarding the transaction price. We allocate the price to the deliverables. Well, our biggest risk is going to be the incorrect allocation of price. We no longer just go 25, 25, 25, 25. We have to allocate the price to the actual deliverable obligations. And finally, recognizing revenue when performance is satisfied. When is that? Is it when a certain time period elapses? When substantially all of the contract is satisfied based on the customer? Or is it when title passes? So we need to think about the risks with each of these processes in revenue recognition in order to determine if we may have some additional testing we may have to be performing. Let's switch over to inherent risks to accounts receivable. We have a lot of risks with accounts receivable as well, both on the side of the sale as well as the rights and obligations of that receivable, which matches our first risk. Is our accounts receivable pledged as collateral for loans, or does it have restrictive use? What happens if that collateral falls through? Have we incorrectly classified receivables in the financial statement? Are we identifying them as current versus long-term or non-current? Is the collection of that receivable contingent on events that cannot be estimated? I will collect that collection of the receivable is contingent upon the customer performing some other obligation. Well, if we can't estimate when that other obligation occurs, then we may not be able to identify that as a collectible accounts receivable. Payment is not required until goods are resold to customers. So I am a jeans manufacturer and I'm selling it to Gap. And Gap says, or the Gap company says that we are not going to pay you until we resell that pair of jeans to the third party, the final customer. That could be a real risk in accounts receivable. You don't know when that sale has occurred, do you? The AR is incorrectly aged. Usually it's 0 to 30 is current. Then you've got 30 to 60, 60 to 90, and usually over 90 days. That's what standard agings come up. But is there issues in the software system that allowed those dates to be moved or changed, which could then age your accounts receivable incorrectly? Are you accepting, is the client accepting orders from customers that violate credit policies? They shouldn't be accepting orders if they are a high-risk company and they don't meet the company policy standards. So you need to look at that and then look at probably your more aged accounts receivable and see what was the credit agreement for that customer. I wanted to provide this to you. And I just Googled it. I looked at fraud types in companies. And one thing that stood out, financial fraud types cited in SEC enforcement actions. SEC enforcement actions are, again, those actions that are against publicly traded companies. 43% of the financial frauds that were going on was improper revenue recognition. This is a huge, huge audit alert for us. compared to having reserves be manipulated, or having inventory misstatement, or having loan impairment issues going on. Improper revenue recognition is really hitting the highlight. Now, it could be a combination of things. It could be some standard financial fraud schemes going on, or it could be as a result of the revenue recognition standard, where they're trying to vet out or shake out the first few years of how this revenue recognition standard is being applied. So this may change as we get further into topic 606. But right now, we have a lot going on. So a lot of our time as auditors is going to be focused right about in this area. And here's some of the schemes that fraudsters could use. Now, again, 2021 is just the second year, really, that the financial reports were really complying with topic 606. So it could be that there's poor training going on, or there could be some issues either on the client side or of the auditor side of not being able to appropriately audit these new standards. But some common schemes that are identified by fraudsters is recognizing revenue on phantom sales, just like ghost employees. You have phantom sales with fictitious invoices. Hidden agreements on contract terms. Consignment sales recorded as final sales. Remember, sales doesn't occur until the consignee sells the goods. So you have to wait for that. You can't, when you move the inventory to the consignment shop, you cannot record sales at that point. Shipping goods to customers who either never ordered them, or received before the agreed date, if the order is occurring between fiscal periods, or they're only sending partial orders when complete orders should be going out the door. Again, look at the contract obligations. Goods that are returned still sit out there as sales. So we return the goods, we give the credit to AR, but we still keep it on the books of sales. That's where your sales and sales returns and allowances need to be aligned to the credit memo to the customer. And purchase orders that are entered as complete sales. Now, there's a lot of fraud schemes out there, but one scheme that attaches to accounts receivable is called lapping. And lapping, easily illustrated. Company A sends their payment to you. That money is stolen. Oops. Now we got to figure out how to make sure that that company A doesn't know their money was stolen. So when company B sends their payment in, we apply it to company A. Then when company C sends theirs in, we apply it to company B. So someone's account is always going to be off. Now, if the customer isn't looking at their account statements, they may not see that. But they may see if we forget to move company B's money to A, and then company A gets a past due notice. That's going to send an alarm out. And usually when that happens, they cover it up with the lapping scheme, hoping that the other companies aren't paying enough attention. Now, let's take a look at some of these fraud risk factors. What risks are out there that may indicate that there could be an instance of fraud? Well, any motivation out there to skew revenue. Remember, take a look at the fraud triangle. Is there pressure or motivation to skew those revenue numbers? Compensation for goals. Bonuses if you meet certain percentages of revenue. That's an internal issue. That could motivate somebody to do some fraudulent financial statement changes in order to achieve that level. Someone who is on, who posts to accounts receivable may have a friend or may have created a relationship with a customer. So they write off their debt. That might be an external pressure. Maybe they could get exposed if they don't write off that debt. Now, looking at the financial statements through the planning, analytical procedures, and substantive testing stages, you're going to identify a lot of your fraud in that area if you're doing sound planning, good analytical procedures, and substantive testing. But one thing you may not catch is identify where there may be a misappropriation of assets for management's own use. I go into the retail store, I'm a member of management, and I take a blouse or I take a suit. Items being taken versus sales. There may be some coercion on that. It might be that employees of a dress shop like Ann Taylor or whoever are required to wear those clothes while on the premises in order to sell the product. Those items may go home. You have to understand management's assertions in their inquiries. Remember, the existence, the valuation. We have to understand what their assertions are to determine whether or not there are fraud risks. Now, the text has many more identified, so please go through and review all of the different ways that we can identify fraud in accounts receivable. Now, when we look at this in the totality, we take the inherent risks and the fraud risks. Those become our control risks. And we look at control risks entity-wide, the tone at the top, policies and procedures, management's influence, and we also look at the transactions. We look at the transactions going into the system. And using both of those risks, we can create the initial control risk environment. Now note, this control risk environment may change as we get deeper into looking at these entity-wide control risks and these transaction control risks. So let's look at management's assertions. We have the existence occurrence, completeness, valuation allocation, and finally, the documentation of controls. And if we're looking at sales and accounts receivable, remember, sales is only recorded when the revenue is earned. So the debit to receivables, the credit is to sales is only when the revenue is earned. Remember, cash, it's a totally different subject. So we want to look at unusual transactions that may be very complex, that require high management review. This is a very complicated contract, and we let management just write us a note as to what they want us to do each month. Could we have segregation of duties issues? Do we have somebody who is able to authorize the sale as well as record the sale? Incompleteness, do we just have sloppy procedures? Look at the procedures, test the procedures. Or is there a desire to minimize taxable income? Remember, revenue minus expenses equals income. Well, if we lower revenue by lowering sales, either by omission or putting them in some odd miscellaneous revenue account, or putting them in as a contra expense account, we might be minimizing our tax responsibilities illegally. So we want to see, do you use pre-numbered documents? Is there timely recording of these sales? Is the client reconciling shipping and billing documents? Is what was shipped what was billed? Are inventory accounts being reconciled? Or maybe they're being used as a, there's an automated inventory system that for every time inventory goes out the door, it automatically updates the inventory count. If it's manual, it could be a little bit more complicated. Our sales, we need to trace sales back to products, records, catalogs, and company records for pricing. Is what is in the catalog actually being charged to the customer? Are we limiting access to those who are controlling the pricing? Is the company ensuring that price changes are authorized? Finally, is there a reconciliation going on? And finally, document, document, document. So in summary of this section of Chapter 9, we took a look at the revenue cycle and the inherent risks. We looked at topic 606 for revenue recognition, knowing that that's a new change. Even though it was implemented in 2018, it is still a fairly new change for companies to comply with. What kind of fraud risks and schemes do we have? What kind of control risks can we be looking at? And what are management's assertions? Again, a lot of detail in this chapter. So please, after you watch this video, read the chapter and reach out to me if you have any questions. So for now, I'll see you in the classroom.